Well, good morning, Kavinder Rana here. The topic of the day is steps to curb misselling in the insurance sector. Steps to curb misselling in the insurance sector. In a bid to address criticism around inability to curb misselling or to curb misselling practices in the insurance sector, the Insurance Regulatory and Development Authority of India has reiterated the need to assess the suitability of insurance policies for policyholders before concluding the transactions. The assessment of suitability for insurance is required to be done in case of saving related life insurance products and annuity products, except those annuities purchased from proceeds of national pension system and from employer offered superannuation fund. So the regulator has directed insurers and distributors to source these policies to obtain details such as the need for buying insurance, income and affordability. Policyholders need that the policy will fulfill expected benefits and so on. So also these should be confirmed by prospective policyholders and concerned salespersons involved in the transactions. So based on the information obtained from the prospect, the insurer or distribution channel, as the case may be, shall recommend a suitable product meeting the needs of their prospect. Such need analysis shall be documented and copy of the same is provided to the prospect, and copies of such need analysis shall be part of the policy document. So as per Insurance Ombudsman Rule 2017, the orders of these quasi-judicial bodies were binding on insurers. However, now the Master Circular states that the insurance companies can choose to appeal against awards passed by Insurance Ombudsman offices within 30 days. These offices adjudicate complaints involving amounts of up to Rs 50 lakh. So insurance companies have to comply with the awards within 30 days, and failure to adhere to this rule will invite a penalty of Rs 5,000 per day for each day of delay. So this provision will not be applicable in case of insurers choose to appeal against the award of the insurance ombudsman within 30 days. In such case, due intimation shall be sent to the policyholders. Insurance industry officials insurance industry officials says insurance industry is dealing with all such cases on prompt and immediate basis, and changes in rules are good because now the insurers have been given the right to appeal against the order. Insurers have to acknowledge customer grievance immediately and resolve them within 14 days, along with reasons for not admitting the complaint, specifying the terms and conditions of the policy applicable in such cases. So aggrieved policyholders can track their complaint through IRDA's Bima Bharosa portal. They can also access details of any unclaimed amount through this website. So the insurance regulator has asked life insurance companies to settle death claims that do not require investigation within 15 days, while claims that involve investigations ought to be settled within 45 days. In case the claim is not settled within the specified timeline, then the claimant is entitled for interest at the bank rate plus 2% from the date of receipt of intimation till the date of payment. Such interest shall be paid by the insurer's suo motu along with the claim amount. So insurance companies will have to process applications to purchase within 7 days. They will also have to, in the case of cashless claims, grant final authorization within 3 hours of the receipt of discharge intimation from the hospitals. In no case the policyholder shall be made to wait to be discharged from the hospital if there is any delay beyond 3 months. The additional amount, if any, charged by the hospital shall be borne by the insurer from shareholders' fund. So the reimbursement claim will have to be settled within 15 days from the date of claim submission. The insurance sector is facing a troubling trend. Mis-selling of product from eager salespeople to misleading insurance practices. Consumer trust is eroding. This is not just a few bad actors, it's a systematic issue demanding attention. The path forward requires a two-pronged approach. First, industries like insurance need to streamline claim settlement process and reduce rejections to regain policyholders' confidence. Secondly, financial institutions must embrace ethical practices. They should acknowledge misrepresentation and compensate for resulting losses. Only then can a healthy and a trusting relationship be rebuilt between businesses and consumers. In its latest economic survey, the Ministry of Finance has projected a robust growth trajectory for the upcoming fiscal year, driven by strong consumer demand and industrial expansion. However, the survey also highlighted the critical need for deeper insurance inclusion to safeguard the financial well-being of the population. According to the economic survey, product mis-selling is too rampant to be dismissed as an aberration of a new, over-enthusiastic sales personnel. The same can be said of the insurance industry as well. The prompt and reasonable settlement of insurance claims and a lower rejection rate are necessary to increase insurance penetration. Acknowledgement of mis-selling and misrepresentation and compensating for consequential losses is a good business practice enjoined upon stockbroking, fund management, banking, and insurance firms. So the economic survey raised the crucial and prevalent issue of product mis-selling in the insurance industry. With tech advancement and the rise of AIM and ML, that is artificial intelligence and machine learning, it has become a lot easier for the industry to detect and prevent fraud in the early stages. To further boost consumer trust and insurance adoption, we need prompt and fair claim settlements. So, identifying and correcting mis-selling and misrepresentation and compensating for losses are non-negotiable practices. For sectors like banking, insurance, and fund management, the stakeholders need to unite in their efforts to bring the consumer and the industry on the same page to build better trust and transparency between them. The survey called for targeted policies to increase insurance penetration, particularly in underserved rural areas, and encouraged collaboration between the government and private sector to innovate and promote inclusive insurance solutions. While our economic indicators show promising growth, we must address the gap in insurance coverage across the nation, particularly in the health insurance sector. Expanding access to affordable insurance products will not only protect individuals and their families from unforeseen financial shocks, but also contribute to the overall stability and resilience of our economy. So mis-selling is a persistent issue in the financial sector, and the life insurance industry or general insurance industry is no exception. Did you know that a survey conducted by the Financial Conduct Authority found that 67% of consumers who reported mis-selling incident felt they were not adequately informed about the product features and risks. So this alarming statistics underscores the critical need for effective solutions to tackle mis-selling. from understanding the root causes and common examples of misselling of implementing advanced technologies and regulatory measures. I see the important aspect because misselling in financial services, particularly in life insurance, refers to the unethical practice of selling a product to a customer that is unsuitable for their needs, typically due to incomplete or misleading information provided by the seller. So misselling can occur in various forms, including omitting crucial details about the product, exaggerating benefits, or not disclosing potential risks. Financial misselling often involves recommending investment products that do not align with the customer's financial goal or risk tolerance. The primary aim is to achieve higher sales commissions or meet sales targets rather than addressing the customer's best interests. Mis-selling is not limited to life insurance but extends to other financial products such as investment and banking services. Some common examples of mis-selling instruments can be seen like exaggerated benefits. Agents may oversell the benefits of a life insurance policy, such as promising high returns on the investment or guaranteed payouts without explaining the associated risks and conditions. Then omitting key information. Critical details like exclusions or waiting periods may be withheld, leading customers to buy policies without fully understanding their coverage. Inappropriate product recommendations. Selling a policy that doesn't match the customer's needs, such as offering a long-term investment linked insurance plan to someone seeking short-term coverage. Then high-pressure sales tactics. Aggressive techniques coerce customers into purchasing policies without giving them adequate time to consider their options. Then misleading claims, making false statements about the policy features, like suggesting it covers critical illnesses when it does not. So the impact of mis-selling on consumers and the industry are very severe because the financial losses are there. Customers may invest in policies that do not offer the promised return on coverage, leading to significant financial loss. Secondly, it will give birth to mistrust. Experiences of mis-selling can lead to a lack of trust in the financial institution and advisors, making consumers wary of future financial transactions. Then emotional distress. Realizing that they have been misled can cause stress and anxiety, especially when they need to claim insurance benefits and find out they are not covered as expected. And also there are impact on the insurance industry also. Reputational damage is there. Mis-selling can severely damage insurance companies' reputations, causing loss of customers' trust and loyalty. Secondly, regulatory scrutiny. Increased mis-selling cases can attract more stringent regulations and oversight from authorities, resulting in higher compliance costs for companies. And financial penalties. Insurance companies may face hefty fines and legal costs due to mis-selling complaints and litigations. And market instability. Widespread mis-selling can lead to instability in the insurance market, as consumers may withdraw or avoid purchasing policies, affecting the industry's overall health. So mis-selling in insurance requires enhanced agent training, stricter compliance measures, real-time monitoring technology, and consumer education to restore trust and ensure fair practices. Because mis-selling in the insurance industry is a pervasive issue that undermines consumer trust and financial security. Understanding the root cause of financial mis-selling is essential for developing effective strategies to combat this problem. Because the primary factors contributing to mis-selling in the insurance sector are lack of proper training and knowledge, high pressure sales tactics, misaligned incentives and commission structure, addressing addressing the root cause is must, because the industry must improve agent training, reduce sales pressure, and align incentives with customers' interest to combat mis-selling. These steps can help ensure that the insurance products are sold ethically and effectively, protecting consumers and fostering trust in the industry. So, to combat insurance mis-selling, a comprehensive strategy involving enhanced training, ethical sales practices, and restructured incentives is needed, thereby enhancing transparency, consumer protection, and trust in insurance products would be there. Thank you. Thank you very much.